Let me tell you something plain, the way I learned it the hard way. The market does not beat you because it is clever. It beats you because you insist on trading when there is nothing to trade. Most losses don't come from bad ideas. They come from bad timing. And there are 2 periods of time that have emptied more accounts than bad tips, bad brokers, or bad luck ever did. Have you ever noticed how easy it is to trade when you shouldn't? I've sat through bull markets and bear markets, through panics and through wild manias, and I learned early that time is a greater enemy than price. The tape talks, but it does not chatter all day long. When it is silent, the smart man keeps quiet too. The first deadly trading time is when the market is doing absolutely nothing. Flat. Drifting. Going nowhere with purpose. You know the kind of market I mean, don't you? This is the market that lures in impatient men. Prices move up a little, then down a little, and nothing follows through. Charts look busy, but they say nothing. The public thinks action means opportunity. It doesn't. Action without direction is poison. I learned that no man can force the market to pay him simply because he showed up on time. Yet how many traders sit there clicking buttons, hoping movement alone will turn into money? In these dead stretches, your mind becomes your worst enemy. You start seeing patterns that aren't there. A tiny breakout looks like the start of a campaign. A small pullback feels like a bargain. And before you know it, you've made 3 trades, all small losses, all unnecessary. Was the market wrong, or were you? The market was simply waiting. You were the one who couldn't. The great money is never made in the middle of the range. It's made when a stock or an index is free to move. When the market is trapped between fear and hope, it punishes both sides. The man who survives learns to sit on his hands. That sounds simple, but it's harder than any clever strategy. Do you know why? Because doing nothing feels like falling behind. But wealth in trading comes from patience, not activity. The tape rewards the man who waits for the line of least resistance to reveal itself. When the chart is flat, the resistance is everywhere. You are fighting the market itself, and the market always has more money, more time, and more patience than you. Now the second deadly trading time is far more dangerous because it feels exciting. It feels important. It feels urgent. It's the moment right after a major move has already happened. The big breakout is over. The panic sell-off is finished. The headlines are loud. Everyone is talking. And suddenly you feel late. Have you ever chased a move because you didn't want to miss it? This is where fortunes are not made, but given back. The market has already said what it needed to say, and now it's digesting. Professionals are taking profits. Weak hands are piling in. The chart starts to wobble. But the story sounds so convincing. This is where hope replaces judgment. And hope in trading is a very expensive emotion. I learned that the public buys after the move because they need confirmation. They want safety. But the market offers no safety at that price. When you buy late, you are no longer trading probabilities. You are trading emotions. And emotions don't read charts. They read headlines. Ask yourself this. If the move was so obvious, why didn't you act earlier? Late entries create bad behavior. You watch every tick. A normal pullback feels like disaster. You tighten your stop too much or remove it entirely. You stop thinking in terms of trends and start thinking in terms of pain. This is not trading. This is reacting. And reacting is how money slips through your fingers. The wealthy trader understands something simple. The market does not offer endless chances at the same price. Missed opportunities are part of the business. Chasing them is how you turn a sound account into a nervous wreck. The correct mindset is not, I must be in. It's, I will be ready when the next opportunity comes. Can you really build wealth if you can't accept waiting? Charts don't reward desperation. They reward alignment. Price, volume, and time must agree. When they don't, the smartest move is to stand aside. I made my biggest profits by doing nothing at the wrong time and everything at the right time. That balance is what separates traders from gamblers. These 2 deadly times, when the market is dead and when the move is already over, test your discipline more than any strategy ever will. They whisper lies. They tell you that action equals progress. But progress in trading is measured by account growth, not trade count. Your job is not to trade often. Your job is to trade well. A trader who respects time learns to respect himself. He stops needing excitement from the market. He stops proving things. He stops fighting the tape. And slowly, quietly, his capital begins to grow, not because he is smarter, but because he is more patient. Most people never lose money because they can't read charts. They lose because they can't rid themselves. They trade boredom. They trade fear. They trade regret. The market merely collects the fee, and it does so without mercy. So when you feel the urge to trade just to feel involved, ask yourself one simple question. What is the market offering me right now, and am I forcing an answer that isn't there? Overtrading is rarely a problem of intelligence, and it's almost never a problem of strategy. Most traders don't lose money because they don't know what a trend looks like or how to place a stop. They lose because they are trading at the wrong times, and they are trading too often during those times. The market isn't punishing your lack of knowledge, it's punishing your sense of urgency. Have you ever noticed how the desire to trade increases when the market gives you the least reason to do so? Urgency sneaks in quietly. It starts with the feeling that you should be doing something. The screen is moving, the candles are forming, the clock is ticking, and your mind tells you that inactivity is the same as falling behind. That is the lie that creates overtrading. When the market offers no clear opportunity, urgency invents one. And once urgency takes control, timing disappears. The trader who overtrades is not reckless by nature. He is impatient by timing. He enters trades too early, exits too late, and re-enters far too often, not because the chart demanded it, but because his emotions did. The market didn't change its character, the trader did. That's an important distinction. Do you see how often urgency replaces discipline without you even noticing? When timing is right, trading feels slow. Decisions come easily because the market is doing the heavy lifting. When timing is wrong, trading feels frantic. You analyze more, you click more, you adjust more. Activity increases while clarity decreases. That's the signature of overtrading. It's not too many trades, it's too many trades in the wrong phase of the market. Sideways markets breed urgency because they feel unfinished. Nothing resolves. Price moves, but it doesn't go anywhere. This creates the illusion that the next candle will be the one that finally breaks free. Traders start taking small positions, then adding, then reversing, all within the same narrow range. Losses stay small, but they stack up. Confidence erodes quietly. The account bleeds slowly, and the trader keeps going, convinced that one good trade will make it all worthwhile. Has that pattern ever felt familiar? Urgency also shows up after losses. A losing trade creates emotional imbalance. The trader wants to fix it. He wants to earn back what was taken. But the market does not respond to fairness or effort. It responds to timing. When you trade to repair emotional damage, instead of waiting for opportunity, you trade against probability. Overtrading becomes a form of revenge, even if you don't recognize it as such. The irony is that most overtraders believe they are being disciplined because they are following their rules. But rules applied at the wrong time are still wrong. A breakout strategy in a dead market becomes a loss machine. A pullback strategy after an exhausted move becomes a trap. Timing is the filter that gives strategy meaning. Without it, even good methods fail repeatedly. Isn't it strange how traders blame themselves, yet refuse to blame timing? Wealth building in trading is not about squeezing profit out of every day. It's about preserving capital until the market makes the path obvious. The trader who understands this stops measuring success by how often he trades and starts measuring it by how well he waits. Waiting is not passive, it's selective. It requires confidence not in the next trade, but in the process itself. Urgency comes from the belief that opportunities are rare. That belief is false. Opportunities are endless, but they are not evenly distributed in time. They come in clusters. The patient trader waits for those clusters. The urgent trader trades through the gaps, and those gaps are where accounts slowly die, not with a crash, but with exhaustion. When urgency controls your timing, risk expands without you noticing. Stops get tighter or wider depending on fear. Position size becomes inconsistent. You start justifying trades instead of planning them. The market feels hostile, unpredictable, unfair, But nothing has changed except your internal clock. You are out of sync with the market's rhythm. The disciplined trader accepts that most of the time, the best trade is no trade. That idea sounds simple, but it's deeply uncomfortable. It forces you to confront boredom, self-doubt, and the fear of missing out. Urgency promises relief from those feelings. Overtrading delivers pain instead. The market doesn't care which one you choose. Timing teaches humility. It teaches you that you are not here to command the market, but to respond to it. When timing is right, trades almost place themselves. When timing is wrong, no amount of effort can force success. The trader who learns this stops fighting and starts aligning. That alignment reduces trades naturally. Overtrading disappears not because of restraint, but because the desire fades. Most traders try to cure overtrading by adding more rules. That rarely works. The real cure is learning when not to play. When you respect timing, urgency loses its power. You stop needing action to feel productive. You start trusting that capital preserved today is ammunition for tomorrow. And once you truly understand that the market punishes urgency more than ignorance, you begin to watch your impulses as closely as you watch your charts, noticing how the urge to act rises precisely when the market offers the least reward, when patience feels hardest, when waiting feels like weakness, and when doing nothing feels unbearable. Trading out of boredom is still trading against the market, no matter how you dress it up. The market doesn't care why you enter a trade. It doesn't reward participation, and it certainly doesn't pay for screen time. Yet boredom has emptied more accounts than fear ever did. I learned early that when a man trades because he has nothing better to do, he is no longer listening to the market. He is listening to himself. Have you ever caught yourself looking for a trade simply because you were already sitting there? Boredom creeps in during quiet periods. When the market isn't offering anything clear, the tape slows down. The charts look dull. Nothing is breaking out, nothing is collapsing. And that's when the trouble begins. The trader feels disconnected. He feels unproductive. He feels as though time is being wasted. So he manufactures a reason to act. A small move becomes a signal. A minor pattern becomes a setup. The market didn't invite him in, but he walks through the door anyway. The dangerous thing about boredom trading is that it feels harmless. The positions are usually small. The logic sounds reasonable. The trader tells himself he's just staying sharp, just practicing, just taking what the market gives. But the market isn't giving anything. It's waiting, and waiting is not the same as offering. Do you see how easy it is to confuse motion with meaning? A bored trader stops respecting context. He no longer asks where price is in the larger structure. He doesn't care whether the market is trending, ranging, or exhausted. He focuses on the next candle, the next tick, the next tiny fluctuation. Trading becomes short-term noise chasing, and noise always favors the market, never the trader. I found that boredom dulls judgment faster than greed. Greed at least waits for something exciting. Boredom acts when nothing is happening. It lowers standards. Trades that would have been ignored on a busy day suddenly look acceptable. Risk feels smaller because expectations are smaller. But small expectations don't protect you from consistent losses. They only make them easier to tolerate until the damage is done. The market teaches patience, but boredom fights it. Patience requires trust in timing. Boredom demands immediate stimulation. When you trade out of boredom, you are no longer aligned with price, you are aligned with your emotions. And emotions don't read charts. They react to silence. The quieter the market becomes, the louder your thoughts get. Isn't it interesting how the urge to trade increases when opportunity decreases? A trader who builds wealth understands that inactivity is part of the profession. Doctors wait between patients. Hunters wait for the right moment. Traders must wait for alignment. Boredom is simply the space between opportunities. But most traders treat that space as a problem to be solved instead of a condition to be accepted. They turn waiting into losses. Boredom trading also creates bad habits. You get used to clicking without conviction. You stop planning and start improvising. Stops become afterthoughts. Entries become emotional. And when a real opportunity finally appears, you are tired, frustrated, and less confident. You've spent your mental capital on meaningless trades. The market hasn't changed, but you have. Do you see how boredom steals readiness? The market moves in cycles. Long stretches of quiet are followed by bursts of clarity. The trader who survives learns to conserve energy during the quiet. The bored trader burns through capital and focus before the real move ever begins. Then he wonders why he can't perform when it finally matters. Trading out of boredom also distorts your sense of performance. You judge your day by activity instead of results. A day with no trades feels like failure. A day with many trades feels productive, even if it lost money. This mindset turns trading into labor instead of judgment. The market doesn't pay wages. It pays for correctness at the right time. I learned to respect boredom as a signal. When I felt it rising, I knew the market was not ready, or I wasn't. Either way, the answer was the same: to step back. The hardest lesson was realizing that doing nothing was often the most profitable decision I could make. Not emotionally satisfying, but financially sound. Boredom whispers that you are missing out, that others are making money, that something must be happening somewhere. But the market is not a continuous opportunity machine. It rewards selectivity. It rewards restraint. The man who trades only when conditions are right may look inactive, but his account tells a different story. Wealth in trading is built by avoiding unnecessary losses, not by forcing gains. Every bored trade risks capital that could be used later, when timing and direction align. The trader who understands this stops trying to extract money from dull markets. He lets them pass. He waits for pressure to build, for ranges to resolve, for trends to reveal themselves. And the moment you stop fearing boredom, the market stops tempting you. You begin to see that boredom is not an enemy, but a test of discipline, of self-control, of whether you can sit quietly while nothing happens, knowing that your edge does not come from constant action, but from knowing exactly when not to act, when to close the platform, when to step away, and when to trust that the market will eventually speak, even if today it has nothing to say, and you are left alone with your thoughts, your charts, and the uncomfortable silence that exposes whether you are truly trading the market or merely trading your need to be involved. Late entries turn good trends into bad trades more often than any faulty indicator ever could. A trend can be clean, well defined, and technically sound, yet still become a losing proposition if you arrive too late. The market doesn't reward correctness alone, it rewards timing. I learned that a trader can be right about direction and still lose money simply because he showed up after the real opportunity had passed. Have you ever been certain about where price was going, only to lose anyway? A late entry usually begins with hesitation. The setup appears, the conditions line up, but doubt creeps in. You wait for confirmation. You want to be sure. By the time you finally act, the market has already done most of its work. What was once opportunity has turned into risk. The trend hasn't ended, but the balance between reward and danger has shifted against you. This is where many traders confuse safety with lateness. They believe that entering after a move has proven itself is conservative. In reality, it's often the opposite. Early in a trend, risk is clear and manageable. Late in a trend, risk is hidden and emotional. Stops become obvious targets. Pullbacks feel violent. Every pause feels like a reversal. Do you notice how anxiety increases the later you enter? A good trend offers room to breathe. It allows for normal reactions without threatening your position. A late entry offers no such comfort. You are buying strength when strength is already visible to everyone. At that point, professionals are no longer accumulating, they are managing positions. Some are distributing. Others are simply waiting for weaker hands to step in. The late trader becomes liquidity. Late entries also distort behavior. Because price is already extended, the trader tightens stops unnaturally. He is afraid of giving anything back. When the inevitable pullback comes, he is shaken out. Then, when price resumes the trend, he re-enters even higher, repeating the same mistake. Losses pile up, not because the trend failed, but because timing did. This is how good trends become bad trades. The chart did its job, the trader did not. And instead of questioning timing, he questions the strategy, the market, or himself. He adds indicators. He searches for filters. But the real issue remains untouched. He is consistently late. Being late is often an emotional problem disguised as analysis. Fear of being wrong delays entry. Fear of missing out accelerates it later. The trader hesitates when risk is low and rushes when risk is high. This inversion is deadly. The market rewards decisiveness early and patience later. Most traders do the opposite. Wealth building through trading depends on asymmetric bets, small, controlled risk for larger potential reward. Late entries destroy that asymmetry. Your upside shrinks while your downside expands. You are no longer trading probability, you are trading hope. And hope has no place on a chart. Late entries also affect mindset. A trader who enters late feels pressure immediately. There is no cushion, no margin for error. This pressure clouds judgment. You start managing the trade emotionally instead of structurally. You watch every tick. You react to noise. The market hasn't changed, but your perception has. Trends don't end because they look obvious. They end when demand and supply shift. But by the time something looks obvious to the crowd, much of the easy money has already been made. The professional understands this. He accepts early uncertainty in exchange for favorable pricing. The late trader demands certainty and pays for it with poor location. There is also an ego component to late entries. Admitting you missed the ideal entry feels like admitting failure. So instead of standing aside, you force yourself in. You tell yourself that being in is better than not being in. But forced participation is expensive. The market does not care about your need to be involved. A disciplined trader learns to separate missed opportunities from bad decisions. Missing a trade costs nothing. Entering late can cost everything. This understanding changes behavior. You stop chasing. You stop convincing yourself. You wait for the next setup instead of clinging to the last one. Late entries also damage long-term confidence. A series of small losses from chasing good trends makes you distrust trends altogether. You start fading moves. You avoid breakouts. You hesitate even more next time. The cycle reinforces itself. All because of timing, not ability. The market offers endless trends over a lifetime, but each individual trend offers a narrow window where risk and reward are aligned. That window does not stay open for long. The trader who respects this does not rush, but he does not delay either. He prepares in advance so that when the moment comes, execution is automatic. Preparation is the antidote to lateness. If you know what you are waiting for, you don't need excessive confirmation. You act when conditions appear, not after they have played out. This requires trust in your work and acceptance of uncertainty. Early entries feel uncomfortable because they happen before proof. Late entries feel comfortable because proof already exists. But comfort is expensive in trading. The irony is that late entries often come from trying to avoid losses. Yet they produce a steady stream of them. Small losses, repeated often, erode both capital and belief. The trader becomes cautious in the wrong places and reckless in the wrong moments. Understanding that late entries turn good trends into bad trades forces you to rethink success. Success is not being right at the top or bottom. It is participating when probability is favorable and stepping aside when it is not. Sometimes that means acting quickly. Other times it means doing nothing at all. A trader who builds wealth learns to live with missed trades. He does not chase them. He lets them go without emotional attachment. He knows that the market will offer another chance, but not if his capital and confidence are already damaged by poor timing. And once you truly grasp that a good trend can still punish you if you enter too late, you begin to watch not just the direction of price, but where you are in relation to it, how much room is left, how much risk you are accepting for how little reward, and whether your desire to be right is quietly pushing you into a trade that no longer makes sense. Impatience creates trades the chart never asked for, and those are the most dangerous trades a man can make. The chart is always honest. It shows you what is happening, not what you want to happen. But impatience doesn't listen to charts. It interrupts them. It fills the silence with assumptions and turns waiting into discomfort. Have you ever noticed how the urge to trade shows up strongest when nothing is actually confirming your idea? Impatience begins the moment a trader stops, trusting time. He sees a setup forming but not completed, and instead of waiting, he anticipates. He convinces himself that being early is the same as being right. Sometimes it works just enough to reinforce the habit, but most of the time it doesn't. The market hasn't made its decision yet, and the impatient trader has already placed his bet. The chart never asks you to predict. It asks you to observe. It asks you to wait for alignment, for structure, for confirmation through price and behavior. Impatience ignores that request. It trades potential instead of reality. And potential, without confirmation, is just imagination dressed up as analysis. I learned that impatience is often mistaken for confidence. A trader acts quickly and tells himself he is decisive. But real decisiveness comes after clarity, not before it. Acting without confirmation is not boldness, it's discomfort with uncertainty. Do you see the difference? When impatience takes over, the trader shortens time frames unnecessarily. He zooms in because higher time frames are taking too long. He looks for signals inside noise because waiting feels unbearable. The chart didn't change. His tolerance did. And as his tolerance shrinks, so does the quality of his decisions. Impatient trades often look logical in isolation. A candle here, a level there, a small breakout forming, but they lack context. They are not supported by volume, structure, or broader market behavior. The chart did not invite the trade, the trader forced himself into it, and forced trades always come with forced exits. The market moves in its own rhythm. Trends develop, consolidate, pause, and continue. Impatience tries to rush that rhythm. It enters during consolidation, exits during normal pullbacks, and re-enters after the move is already extended. The trader feels busy but ineffective. Losses appear random, but they are not. They are timed perfectly against his impatience. One of the most expensive lessons I learned was that being early feels exactly like being wrong. The market doesn't reward anticipation. It rewards confirmation. Yet impatience cannot stand to wait for proof. It wants relief now. It wants certainty now. And since the market doesn't offer that on demand, impatience invents it. Impatience also weakens discipline. A trader may have clear rules, but impatience bends them. Just this once. Just a little early. Just to get a better price. That small exception opens the door. Soon, rules become suggestions. Structure dissolves. The trader no longer knows whether he is following a plan or chasing a feeling. Wealth building in trading depends on consistency. Not daily consistency, but behavioral consistency. You must take the same type of risk under the same conditions again and again. Impatience breaks that rhythm. It creates uneven risk, uneven execution, uneven results. The account reflects the disorder long before the trader admits it. There is also a psychological cost. Impatient traders lose trust in charts. They feel betrayed when trades fail, even though the chart never confirmed the entry. Over time, this creates confusion. The trader stops knowing what works because he never allowed anything to work properly. Every idea is cut short. Every trade is interrupted. The market does not move to accommodate your schedule. It does not care how long you have been waiting. Impatience believes it deserves a trade because time has passed. The market believes nothing of the sort. Opportunity is not a reward for endurance. It is a result of alignment. Impatient traders often say they are afraid of missing out, but what they are really afraid of is stillness. Waiting exposes doubt. It forces you to sit with uncertainty. Impatience offers escape. It offers action. But action without confirmation is not progress, it is avoidance. The disciplined trader learns to recognize impatience as a warning sign. When the urge to trade rises without new information from the chart, he steps back. He understands that his emotions are speaking louder than price. He knows that trades taken to relieve tension rarely produce profit. The chart asks for patience because patience preserves capital. Capital is opportunity stored for later. Every impatient trade risks that storage. Over time, the trader who cannot wait runs out of ammunition. Then, when the real setup finally appears, he is either undercapitalized or emotionally exhausted. Impatience also distorts risk perception. Trades entered too early require wider stops or tighter hope. Either way, risk increases. The trader justifies it by saying he will manage it later. But later usually comes faster than expected. The greatest shift in a trader's career happens when he stops trying to make things happen and starts allowing them to happen. That shift cannot occur without patience. Impatience keeps you in constant reaction mode. You are always adjusting, always correcting, always chasing equilibrium, instead of letting the market establish it first. The chart speaks in its own time. It does not rush. It does not explain itself. It reveals truth gradually. The trader who listens learns to wait for the market to finish its sentence before responding, instead of interrupting halfway through and acting on assumptions that were never confirmed, driven by the discomfort of waiting, the illusion of control, and the quiet fear that if he does not act now, something important will pass him.